Good afternoon, everyone, and welcome to our Shoesmiths webinar, Shared and Halved, in relation to COVID-19 and in particular, liquidity in these uncertain times. My name is Nat Barnes and I'll be the moderator of this webinar. I'm a partner in the corporate group at Shoesmiths and I specialise in banking and finance and in particular asset-based lending. This webinar is part of our Shared and Halved initiative that we are running across Shoesmiths, aimed at business leaders to look at the implications of the coronavirus crisis and to help you work through some of the challenges that you will be facing. We are seeking to bring together client groups to share insights and thoughts and to also pose questions, not only of our lawyers here at Shoesmiths, but also amongst each other. We very much want to create a sense of community with what we are all going through at the moment and to help work together in the coming weeks and months to find some solutions. To help facilitate that, we have an online COVID hub, which some of you may have already accessed when signing up to this webinar. I would really encourage you all to regularly check in there as we are constantly updating that site with material that we think will be of benefit to you. This afternoon, you're going to hear from three of my colleagues with their thoughts on liquidity at the current time. Kicking us off will be Nick Iliff, who will be discussing the support that is available from the government. I think Nick would just like to introduce himself to everyone.
Hello there, yeah, I'm Nick Iliff, another banking partner for everyone.
Thanks, Nick. Following Nick, we're going to have Neil Fawkes, who's going to be talking about how some of those government initiatives have been implemented and also your relationship with your bank.
Afternoon, yeah, I'm Neil Fawkes. So I recently joined Shoesmiths, been with them for about a year now, but previously lived a life working in high street banks, most latterly as a regional managing director for mid-markets in Lloyd's across the south. Thank you.
Thanks, Neil. And then last but definitely not least, we're going to have Tim, who's going to be sharing some insights around other potential support that's available to people out there.
Yeah, good afternoon, everybody. Afternoon, it's Tim McNamara. I'm also a partner in the banking team based in Manchester and Leeds. Been with Shoesmiths for about 3 years now, nearly. Before that, I was also at High Street Bank. Thanks, Nat.
Thanks, everyone. So just to let you know, we've already received quite a few questions, so I'll be posing those to you as we go through the session at the appropriate time. If anyone else would like to pose a question, please do so using the chat function, and we'll try to get to those at the end of the session. So without further ado, if Nick would like to kick us off.
Yeah, okay. Thanks, Matt. Thanks, everyone. Welcome, everyone, to our webinar. The government support, so I'm going to talk briefly about government support, and it's something which I've been focusing on for the last six weeks or so in terms of working out what's available for businesses. Government support is basically comes in, or you can categorise it in three ways. First of all, there's the support which we're probably most familiar with, which is relief from current costs. So, for example, there's rate relief for small businesses and for retail, hospitality and leisure businesses. Connected to that, there are direct grants. There's been tax deferral, which people have taken advantage of. Employee furloughing, which has obviously been in the news quite a lot as well, protection from eviction, protection from what would normally be wrongful trading. So there are various relief from the current impacts of coronavirus, which a lot of people are entitled to. The next line of support is new schemes to support borrowing, and those started on the 23rd of March with the C-bills and have expanded and I'll come on to talk about how they've expanded over the last weeks and month or so. So from the smallest up, we've got the Future Fund, which is intended to support on a matched basis with convertible loans from £125,000 to £5 million new startup businesses, high growth businesses, and the principle which is applied to that is that those borrowers probably wouldn't have been able to access the C-bills loan. I'll come on to talk about why in a moment. The entry points are, first of all, they're UK businesses. Secondly, that they've raised £250,000 of equity in the last 5 years. and the whole scheme will be launched next month. There are some headline terms which the government's issued on their webpage already, so that's already quite a well-developed product, although not officially launched until next month, and I'll talk a bit more about that slightly later. The newest scheme is called the Bounce Back Loan, and I think that was a response to the fact that people have been applying for CBILS, but it's just been taking quite a long time to get through, first of all in terms of qualifying, secondly in terms of the banks getting themselves together, which is not a criticism of the banks at all. It's just a complicated and new and large system which needs to be put in place. So these bounce back loans were announced at the beginning of this week. They're intended to be very easy to access through an online process. They're 100% guaranteed by the government. They're quite relatively small, low value loans, so from £2,000 to £50,000. There are no repayments for the first 12 months, and the loans will last for up to 6 years. So that's the newest, and in terms of quantum, the smallest. The next one, and probably the one with which everyone's most familiar, is CBILS, or the Coronavirus Business Impact Loan Scheme. That was the first scheme to be announced, which was on the 23rd of March, and loans are now being completed, and Neil will come on to talk about, first of all, the volume of loans which are being completed, and also a bit about how to apply for them and what the best strategy and tactics you should use. 52 banks have now registered to provide the CBILS product. They support regular term loans, asset finance, invoice discounting facilities, and revolving credit facilities, which would include overdrafts. And I think we've seen between us examples of all of those. Neil's also going to talk about the guarantee side of the CBILS, the personal guarantee side of it. The applications for CBILS are from businesses with turnover of up to 45 million, and the loans can be up to £5 million. So that's the first one. And when that was launched, everyone was saying, well, what happens if you're a large business, but you're not an investment grade business? What happens if you're a large business with a turnover greater than 45 million, but you're being impacted by coronavirus? So the response to that was the Coronavirus Large Business Impact Loan Scheme, which is very similar to CBILS, except it doesn't have the interest-free period for the first 12 months. It's for larger businesses with turnover of over 45 million. There's no upper limit on the size of turnover for those. And the loans can be up to £50 million. And then with that, there are personal guarantees, or there can be personal guarantees, but those are limited to 20% of the bank's losses. So CBILS and CLBILS, as they're known, are both broadly similar. But again, with both of those, there are plenty of criteria you have to clear to be able to get to them, and which reflects again the point I made a moment ago, which is about businesses' frustration with the slowness in which those have been deployed. But anyway, we can come on to talk a little bit more about that in Neil's bit. Then finally, and again, announced at the same time as CBILS, but probably the one I've talked the least about, is the Corporate Financing Facility, which is a system which is supported by the Bank of England, which will buy investment-grade commercial paper, and it's for economically significant UK businesses. So, I mean, again, talking about this gap in the original scheme, CBILS covered up to 45 million, then you had a gap, but you're thinking, what happens if you're a company which has a turnover of over 50 million, or has a turnover of 300 million or 500 million, but isn't investment grade, which there are plenty of. So the Corporate Finance Facility is quite a narrow product, but I think it's the one under which the most money has been lent to date. So that's the second form of support. And then the third form of support, which if you go onto the government web pages, you'll find, is redirection to existing forms of business support. So, for example, British Business Bank Startup Loans Programme, or UK Export Finance, or Innovate UK scheme. So all of those are pre-existing facilities and pre-existing forms of government support which you can use if one of the particular products doesn't suit you. So that those are there as well, and we can come back to talk about a couple of those later on. a question which came up, and particularly in the context of CBILS, and actually goes back to this thing about loans for venture companies, is are these schemes available to loss-making companies? The answer is, if you're loss-making, you're not specifically disqualified. If your business was a business in distress, which is a particular EU terminology, if your business was a business in distress as at the 31st of December 2019, then you wouldn't be entitled to any of the support schemes. But the fact that you're loss-making now doesn't mean you're not entitled to apply for the CBILS, CLBILS, and all those forms of support. It just means, and throwing something over to Neil again, asking Neil to provide the actual things you're interested in, is that what you have to have is a plan. What you have to have is a plan which shows that if you access these loan schemes, you'll be able to trade through them with the help of the CBILS loan or the CLBILS loan, or whichever scheme you're using. So you have to be able to have a plan going forward. The fact that you're making a loss now is not necessarily relevant. The relevant bit is that you've got a way through it. As I said, each scheme has its own criteria based on size of turnover, but the overriding consideration in all the schemes is your business has been impacted by coronavirus and has a business proposition which the lender would consider viable were it not for COVID-19. So those are the kind of key entry points. And with each different scheme, there are obviously other trills which you need to deal with. And then the loan would enable you to trade out of the current short to medium term difficulty.
Nick, we've had
one other thing.
Sorry.
Yeah, go on.
We've had what's probably quite a poignant question from someone, which is, do they have to have an existing relationship with one of the accredited CBILS lenders?
No, but no, you don't. But the government pages say, and understandably, you're best to go to your own relationship bank first, not least because your relationship bank's probably going to know your business and recognise the coronavirus impact. So they say that. But if your bank turns you down, or if for some other reason, because you're seeking a different form of support, you want to go to one of the other lenders, you can do that. And as I mentioned, there are 52 approved banks, so they'll provide different products on different terms. So point of entry, tactically, probably go to your relationship bank first. But if they turn you down, or if for some other reason you want to go to one of the other lenders, you can do that. So you don't need to do that. And just as a final point, in all the CBILS literature in the British Business Bank, it says decision making on whether you're eligible for CBILS is fully delegated. So the decision on whether to lend or not is with the lenders. So that's kind of where I'm up to. One other thing, I won't talk about too much, but one other thing to be aware of is state aid. So we can talk about that if questions come through on that, and that's quite an important aspect of it all as well.
Okay, well that probably seems a good juncture to hand over to Neil on the basis you've delegated a few bits anyway. So Neil, do you want to pick up on a couple of those points there Nick's already raised?
Yeah, I'll try. So thanks again. So I've spent pretty much most of the last 4 or 5 weeks trying to maintain relationships primarily with the 4 high street banks to understand how they're approaching the challenge, the huge challenge that sits in front of them, and how they're acting and how it's evolving. And it does continue to evolve pretty much on a daily basis. In fact, there's more evolving of the CBILS scheme this week in respect of requirement for forecasting versus 2019 performance in respect of how you repay or justify the granting of the loan. So I'm going to try and wave the flag a little bit for the high street banks, if I may. I think they've had a hugely difficult task to approve any loans because the primary way that high street banks will assess any facility is against a defensible and a visible cash flow of the future in order to repay that debt. And at this time, that's obviously hugely difficult to put any sort of stake in the ground as to where they believe future cash flows are going to be. So in the face of that, I think they've done a good job. I think they continue to evolve, and I think week by week that there is an acceleration in the provision of facilities, and there is a slicker machine within these banks as well. again, talking to the banks, NatWest gave me an example that they historically they expect to get 3,000 calls a day into their call centres. They're getting north of 25,000 a day at the minute. So that's the size of the challenge they've got. On average, they think their relationship directors have got 5 times more credit applications on their desk than they would have typically. So I think they are working well. They are definitely becoming more agile. I've seen some great examples of stuff that certainly I never saw or believed would ever happen within high street banks when I was there. I'll give an example. I won't tell you which bank, but a £5 million CBIL loan was granted, approved. Customer was in desperate need of the liquidity. An email was sent with the terms of the facility and a request for the client to just agree to the terms via email. The client did. The funds were then remitted into the client's account on an on-demand basis, pending completion of documentation. That sort of agility and flexibility is something that certainly I never saw, and is fantastic in respect of, let's not forget, these banks are huge machines that take a long time to move, and they're doing these things regularly. They're becoming more agile. They are also learning the systems that we're asking our clients to learn in respect of what finance and funding is available. And I think are doing a great job. I mean, there's north of, get my numbers right, there's north of £2 billion worth of CBIL fund or COVID-19 funding supplied by the 4 high street banks. On top of that, there's another £2 billion which has been provided by way of traditional lending. So I think they have reacted well. I think it was slow to start with, and I'm sure a lot of our listeners will relate to that. But work with them, communication is critical at this time with them. And I think one of the questions later on I'll come back to is some tips around what a good application looks like for a COVID facility. So maybe come back to me on that one. Hopefully that's what you wanted, Nat.
Yeah, thanks, Neil. Like I said, we'll come back because we have got a few questions lined up that people have already sent through. One question to pick up now, and Nick briefly touched on this. I know a lot of people are concerned around the PG element of some of these CBILs. In the people you've been speaking to at the banks, what's sort of the PG appetite, and some people expect to have to put up a PG?
Sure. So below £250,000, no, absolutely not. Above £250,000, it depends upon the makeup of the balance sheet. Frankly, if there is a weak balance sheet that needs some support against it, I think it would be fairly typical for the banks to ask for that. The only bank that's taken a stance which is probably removed itself, and again, I'm only talking about the four high street banks, so HSBC, Barclays, NatWest and Lloyds. The only one that's slightly different is NatWest have declared that they will not take PGs at all for any COVID lending. The other 3 will, if there's a shortfall of tangible value on the balance sheet, they will look for some support by way of a personal guarantee above £250,000.
Brilliant. And Nick also mentioned, there was, I think it was 40 lenders originally, and that's now up to over 50. Do you think as more and more lenders come on, the rate of sort of take-up of these loans is going to accelerate? Because, as you said, it was a bit slow to start, and as people are getting more agile, we're going to see more and more of these things flying out the door, do you think?
Is that for me? Sorry.
Sorry.
Yes, yeah. Sorry, yes. I thought you did, Nick. That's fine. Yes, I think so. And again, I think the banks are getting used to it. I mean, they are redeploying staff into teams to help support these applications because of the sheer mass of them. Pretty much across all 4, again, the first 2 weeks were pretty quiet, and I think that was basically clients and banks trying to understand what it was. And the last 2 to 3 weeks, there's been a steady increase. It has flattened in the last 4 or 5 days, so I think they're probably getting a steady stream now. But the clients that want them, I think they've probably had 60-70% of relationships contacted. And either that's proactively or reactively, frankly. I mean, most of the high street banks are proactively going out to customers they haven't heard from just to make sure they're okay, which again is a great example of what they should be doing.
And I was really interested to hear you talking about the new agility that these sort of big 4 have got, which is not something we necessarily associate, as you say, with such big machines.
Yeah.
Is that something you think will stick post-COVID? Is this sort of
I hope so.
gate being opened?
I hope so, and frankly, every bank that I talk to as well hope so, because it's all client focused and client positive. I mean, the example I gave around the £5 million loan was just like unheard of, frankly. I mean, they have just dropped £5 million into this bloke's bank account on an on-demand basis, pending completion of documentation. The other sort of stuff I've heard about is increased overdraft limits, pay excesses, pending completion of the loan process. E-signing of documents, again, wasn't in any of the 4 high street banks 2 months ago, pretty much across all 4 of them now, in respect of they will take e-signatures. And we've probably seen a little bit of that ourselves within our own company, haven't we? So I would imagine it's pretty difficult to take it away. I haven't asked that particular question, is this going to be here forever? But if they've done it in a time where they've pumped more liquidity into the market than ever before, it would seem strange to then take it away.
Indeed. Yep. Well, welcome if it stays.
Fingers crossed.
We're also going to get a barrage of people on the chat saying they put in a request and why didn't they get their 5 million straight in the bank?
Maybe.
Deal with those. Jim, perhaps now we pass over to you. You know, we've talked about all these sort of government schemes, but you know, if people either don't qualify or they just don't want to take the additional lending that's made available by CBILS, what are the other options that people can look at? I think you're on mute, Tim.
It should have come off now. It was a bit slow to come off mute. Am I off mute now?
Well, I know. Thank you.
Right, good. Yeah, thanks very much, and absolutely agree with what Neil was saying there. The agility that we've seen and the fast-moving processes that the banks, especially the high street banks, have put in place is quite astonishing, really. And having worked in a bank for quite a while as well, it's not something I ever saw. So that's a really welcome advancement, and I hope it stays. I suppose from a perspective of liquidity and traditional lending outside of the government-backed schemes, there is still quite a lot going on, which was probably just in the pipeline before COVID really hit and lockdown really hit. So in the main, credit sanctioned deals are still going through, and that liquidity that has been credit sanctioned previously is still being kind of honoured, if you like. Saying the main, I've only seen one example where a second tier bank unfortunately did a bit of a U-turn on a credit sanctioned lend for a property development, which put the customer in a little bit of difficulty. But in the main, like I said, these credit sanctions are being honoured, and that new lending is being processed. It's obviously taking a bit longer. But in terms of sort of proper or emergent or new lending outside of the government schemes, to be honest, I haven't seen a great deal of that, and in a way it makes sense, because the banks would rather lend under the government-backed schemes than not, and probably the customers are probably going to get a better deal using the government-backed schemes than a bank priced and a bank credited transaction. So in terms of new lending, there is still some going on, but it's limited. I think I'd also say that it's limited to existing customers, again, for obvious reasons. New to bank lending, refinances where a customer might be moving from one bank to another are very unlikely, I would think, in the short term. I think customers are advised to stay where they are and with their existing lender. So I suppose you might ask what have the banks been doing aside from CBILS and CL bills if they haven't been doing any new lending of kind of their own that isn't government backed. And certainly what I've seen is they have proactively speaking to customers from the off, not waiting for a call from a second customer, proactively going out to their customers on their existing loan book and asking them how they're doing, how are they foreseeing the next quarter or the next 2 quarters, and working with them. And I think the RDs on the ground have been empowered a lot more than traditionally. It's frozen there. Can you still hear me?
Yeah, we can hear you.
Can you still hear me, guys?
Yes, yes, you're
Yep. So yeah, so I was saying that the RDs on the ground have been empowered. Yeah, the RDs on the ground have been empowered. They don't have to necessarily take everything to credit. So things like a permanent waiver or a reset or a capital repayment holiday, those kind of tweaked loan are flying through a quick one-page side letter and we're done. And there isn't that usual sort of costly and time-consuming process where an RD has to go through credit. So there's been a lot of those things. I'm sure we'll probably come on to valuations a bit later. So valuations have been deferred, which is another item of flexibility that high street lenders have been. I have heard anecdotally lenders perhaps don't have that degree of flexibility because they're regulated.
Tim, we'd actually had that as a question from somebody saying, they were in the process of a real estate finance loan, but the valuation hasn't been done. So any ideas on what would happen there?
Do you want me to have a go at that? No?
Yeah,
Okay.
There is a bit of a lag on my system. I'm only
Don't worry.
in Manchester, but there is a time difference. You started asking each other.
Okay, no worries. So again, High Street Bank. I think there's a huge difference between, as Tim talked about, incumbent and new customers. If you've got an incumbent customer with a track record with the bank, that's done facilities before, I have seen real estate lending done via a drive-by valuation with an understanding and a condition subsequent that a full PV will be conducted as soon as possible. But for new clients into new banks, it's difficult, I'm afraid.
Yeah, I think just to add to what Neil says there, and completely agree with Neil. I think I'm just about to be instructed on a ground rent lend, a new to bank ground rent lend, which obviously you can value a ground rent portfolio without actually visiting the site. So there's an example of there are some assets that you can do a desktop valuation on, and it works. But I think all of them are pretty much saying, we can give you a valuation if you want one, but we might not have inspected it to the full you expect us to. And I think some of the valuers have said, well, we'll get somebody to go around with a camera and do a video of it, but it's still not the same for a funder. And I think the other point on valuations is practically they're difficult to get, but also you've got to question what worth there is in a really limited market where there aren't any comparables to really speak of. So I think all the valuers are still making their valuations subject to this material uncertainty caveat, which again, from a funder's perspective, you sort of say, well, what's the point of doing that now? Let's wait and get one when we can get a proper one. So valuations are proving tricky, and I think that's kind of prohibiting new lending in most sectors.
Thanks, Tim. Another question that's come in is somebody who's got a facility that is up for expiry in the next month or so. Any indication on what chances of a refinance of that are? What likely the bank will do with that?
Yeah, I think it's a question I've touched on with a couple of my contacts at high street lenders, and I think all things being equal, and again it goes back to valuation. I think they just roll it on for 6 or 12 months on current pricing. Again, all things being equal, if the business is struggling anyway and would be without the COVID shock that we've had, there's probably a discussion to be had there. But again, all things being equal, and if the refinance is stalled just because you can't get a valuation, for example, I think the banks would just roll that on.
I think, Tim, as well, I would add that it would probably be more attractive to a bank to roll on an existing facility rather than refinancing, because there's a cap on how much refinancing can be done through the CBILS, so that each bank will get an allocation, and only I think 20% of that can be used for refinancing. So I think the idea of extending an existing facility rather than fully refinancing it is probably going to be more attractive to the banks as well. And also you'll have, I imagine, a better line of sight in 6 months' time than you do now. So it'll probably make it easier to negotiate terms in 6 months' time than it is right now.
I suppose the extra bit on that is that if we talk about a refinancing to include a rebank and moving to another bank, I think moving to another bank is going to be hard. But I think a refinance with your current bank, all things being equal, you should be able to get through.
Right. Better the devil you know for now then. Nick, just picking up on something you just mentioned there, talking about refinancing. Can the CBILS scheme be used for refinancing?
Yes, they can. But as I mentioned, so the answer is yes, and that's the straight answer. But each bank's got an allocation, and it's only a limited. And within that allocation, there's only so much they can use for refinancing. So I guess if one of the high street banks is looking at that allocation, they won't be thinking, "Oh, we're going to refinance every single facility we've got with CBILS." Because then I suppose that the answer to that is then there's a potential, and I'm not suggesting that anybody we know would do it, but of abusing the guarantee scheme to get all of your existing facilities 80% guaranteed by the government, which is probably not what the intention of the whole kind of structural support is really. So yeah, you can refinance, but it's not as deep a pot as the overall CBILS and CLBILS pot.
Sure. Another question from someone is they're a fledgling business, so they don't necessarily have the trading figures. Where should they turn? Where's the best option for them at the moment?
Well, the answer to that, I think, and I mentioned it at the beginning with this whole thing, but so we did about 3 weeks ago a webinar with our VC clients, and so look, we've got no track record. And in fact, because we're a startup business, we wouldn't normally go to a bank anyway to borrow money. We'd normally get money from our investors. So them applying for a CBIL loan, because the CBIL loan is basically done on this but-for test, if you can call it that. So but for COVID, you would get money from the bank. But for COVID, most startup businesses wouldn't get money from the bank, so they were disqualified from CBILS, which is why this future fund has come along. I mean, it actually hasn't started yet. It starts in May. But the future fund, as I think I mentioned in my opening remarks, will provide matched funding from the government up to £5 million, but provided you've got a previous fundraising track record, which is we turned 250,000 in the last 5 years. So high growth businesses, startup businesses, because CBILS just wouldn't pass the entry point test, which is but for COVID you would get a loan, are entitled to use the future fund, which is entirely intended exactly to look at high growth businesses. And then I suppose also if you're a fledgling business, you may look at the bounce back loans as well, because they're less stringent in their requirements. But yeah, essentially the future fund was the one. And the other one to mention, and I'm not that hot on it at all, is the Innovate UK, which is an example of an existing government support mechanism for innovative research and development style businesses. And they've made available extra funding for their existing, what they call clients. So existing Innovate UK clients can use that, but they've also offered additional support for other innovative R&D type businesses. So there are at least 2 other ways if you wouldn't qualify for the CBILS or the CLBILS lending, and you're a fledgling business, you could get access to additional capital with government support.
Fabulous, thank you. Neil, you dangled the carrot earlier and mentioned you were going to talk about what to include in any application to your lender. I think people are definitely keen to hear more on that. So can I ask you to pick that up, whether it be a new application or perhaps a forgiveness of some kind?
Sure. So I think any time actually, when talking about communication is key, but never so more important than now. So an open, regular contact with your relationship director is really, really important. I think definitely your incumbent bank, they know you best, irrespective of KYC and account opening processes that they'll all have to go through for a new bank. Actually, just the fact that your incumbent bank knows you, knows how you behaved in the past, has a track record, that they are definitely the place to go, as well as security and stuff like that. A full financial pack, so integrated if possible, both going back a couple of years and if possible, your best guess as to what the future looks like, and be really clear with the assumptions you've made around what the future looks like. Now, certainly the 4 high street banks, when lending money, are required now by the government to look at what your cash generation was like in your last trading year up to December 2019. So they will use that number to confirm affordability of any facility they're giving you now, unless there is something really, really obvious as to why that 2019 number is not relevant for the future. So that you're not required now to give future forecasts, but frankly, why wouldn't you? You're the person running that business. You're the person that has the best understanding of what it's going to look like in the future. You want an open and honest dialogue with your bank, so you don't have to give it to them, but I'm a bit unsure as to why you wouldn't, frankly. The other stuff to be really clear on is be clear as to what levers you've already pulled within your business. So those levers being furloughing, rent, tax, dividend payments, capital moratoriums, all that sort of stuff. Be clear as to what you've already done, and stuff that you haven't done, be clear as to what needs to happen for you to pull that lever, and then explain what is still required within the business. So if you've explained all the actions you've taken already, then just give some detail around what the costs remaining in your business are and why they remain. Now, you don't have to have positive responses to all those questions. So, for example, you might have gone to your landlord and you've asked for rent reduction, but that's not able at this time. But be clear to tell your borrower that you've asked for it. Tell your bank that you've asked for it, so they understand that they are not picking up everything. Actually, all creditors are taking their fair share, and everybody's supporting. And again, just 2 things to repeat that I've already said. Really, be really explicit about the assumptions you've made, because although they may be clear to you, make sure they're clear to your bank, and communicate. Just continue to have regular dialogue, even if you don't think there's much to say. They will definitely want to hear from you at the minute, so try and have as much regular communication as possible. I see there's a question from around the caravan business that's been asked. So the question is, we're a UK-based manufacturer of caravans directly impacted by cancelled orders, productions, dealers closed. Challenge in the CBILS application is demonstrating direct impact and cost to catch up. Hopefully some of that has helped. Again, the banks should be able to provide CBIL funding against historic cash generation. So they will be looking at what your business has historically done, and if 2019 was a bad year for whatever reason, Brexit or whatever, they should be able to take averages of previous year's cash generation. If you can demonstrate that by past performance that you can afford to take the additional borrowing that you are wanting to take now to support your business, they should then be able to provide you that funding. I'm not sure how helpful or how clear that is, but I'm very happy to pick that up bilaterally after this call. If somebody wants to pick that up with me, I'll be delighted to help.
Can I add as well, Neil, just to kind of supplementing what you've said? All of the CBIL application forms I've seen are actually just picking up stuff which is in the government requirements. So I mean, each question has a purpose and is addressing a particular requirement of CBIL. So that to your point, Neil, I think you need to answer those questions thoroughly and thoughtfully as well, rather than, it's not just some of the questions, if you were asked in the ordinary course of business, would be quite annoying questions, but I think they're all ones which are there for a reason. So, well worth answering as fully as possible.
Agree, because in the future, any claim against any any future claim against government guarantee will result in some audit of the lending process that the banks have gone through to lend that money in the first place. So they are potentially, to Nick's point, asking questions that you may feel that they should know the answer to, but it's the audit process and the audit that the government are asking the banks to complete.
Another question in from someone suggesting that their lender's not currently accredited for CBILS and wondering where they should go. Might put that to Nick if I may, but just before I'll cross the divide and just chip in if I may for a moment. Just I feel sort of duty bound as an asset-based lending lawyer to just mention we're using the word banks a lot, and obviously it's not just the big four we're talking about here. There are, there's over 50 lenders accredited. A number of those are asset-based lenders or alternative finance providers. So my advice would also be, one, check the British Business Bank regularly, because more and more people are being added. And I, in particular, am working with a number of clients to help them through that process and get accredited by British Business Bank as soon as possible. So maybe keep the conversation going with your regular lender and see if they are in the process of going through accreditation, or whether it's just something that they aren't at the moment looking at, and then in which case you may need to look elsewhere. But have that conversation first. Nick, I don't know if you've got anything else to add on that.
No, I think that's right. And I think, as I said, at the outset, and Neil has emphasised, it's your relationship bank is probably where to start. But if you're looking for particular types of funding, then you can look through the list of accredited banks on the British Bank website, British Business Bank website, and see who's in there who may be more appropriate to your needs. And also, kind of picking up on a point with Neil, if NatWest, for example, are getting 25,000 calls a day, it may be that one of the other lenders could be more responsive. Because I think certainly in the first few weeks, everyone was complaining about lack of responsiveness, and I think that's kind of been addressed a little bit now that everyone's got their systems going. But I mean, if it's a response you're looking for, and if, for example, you've got an invoice discounting facility is what you're after, it may be that one of the specialist invoice discounting accredited lenders would be as good a place to start as your existing relationship bank.
Excellent. I've got a quite potentially tricky one from someone saying until now they've kept their SME business afloat without taking on loads of debt, and obviously they're not keen to suddenly saddle the business with debt. Any ideas on what they could look to do instead?
They could take on more government equity if they wanted to. If they want to do some fundraising. But so the government are providing convertible loans, but it would mean ultimately, unless it's paid back, so you'd be taking on a convertible loan, the government would have equity in your business. And as I mentioned, there is a term sheet, and we have got a webinar coming up soon from our corporate colleagues on the future fund. But I think there are some features of the headline terms which we had questions about. So it's interesting. I mean, you could effectively take on debt in the form of convertible loans if you didn't want to take on pure bank debt, and that's a possible one. And I suppose the Innovate UK as well is grant funding. And then back to my opening point, which is some of the funding available, and it's available to SMEs as it is to everyone, is the sort of rates, grants, and all that stuff. So there are other non-borrowing forms of relief. And as Neil said, when you're going to your bank anyway, you probably want to demonstrate you've exhausted those lines of research as well as just applying for a loan. So I think there are some things you could do to shore up your business apart from just purely debt borrowing.
Yeah. So the advice is take advantage of all the schemes you can that are out there.
Yeah.
Whether you are taking CBILS or not, you should be making the most of these.
Yeah, I guess the only potentially obvious other one to add to Nick's is just maximise your working capital cycle as much as you can as well. If you've got strong creditors or debtors that you can stretch, then do that.
Yeah, thanks, Neil. I think this question might be aimed at you, but and I think I know what you're going to say, which is, do you believe the banks are doing enough to support their customers at the moment?
Yes. I think the banks have been as shocked by it as pretty much everybody has. I think it took them a while to react, but understandably, as we've already referred to, these certainly high street banks are huge organisations, and like Tim, having worked in one for 30 years of my life, getting anything changed was pretty massive and pretty long and pretty painful. So the innovation, the agility that I've seen in the last 4 or 5 weeks is hugely surprised me. I think it is a really difficult task for the banks. Again, repeating a point from early on in the call, banks lend money against secure repayment sources of the future, and the repayment sources being the cash generation of the businesses they're lending money to. And frankly, can any business do that at this time? So I think it's a really difficult task the banks have been set. I think it took them a while to get their responses in order and their processes in place. But across all 4 that I've spoken to, they've done that. They're coping with significantly higher demands, and I believe are doing as good a job as they possibly can at the minute. I think they need to continue doing that, and I think the government schemes will continue to evolve as they have done pretty much every week. And I think that evolution is a function of a cry for more liquidity to go into the market. So the government continues to loosen the parameters each week, and it's the banks that have to comply with those rules. And as the parameters get wider, the bank will continue to pump the liquidity out. Hope that answers it. I hope it doesn't sound like I'm too much of a pro banker.
Right, we'll forgive you as an ex-banker on the payroll, though. Question maybe for Tim. The new agility that we've talked about a bit, have you seen that sort of transpiring as some weird and wonderful condition subsequents that are being added to any of the documents you've looked at recently?
It's a really good question, actually, and it's a really good point that I think a lot of people miss, that whilst you can laud the banks in a way and say, aren't I great for waiving, or deferring capital repayments and allowing for interest roll-up, it is in effect making those payments a condition subsequent, because it's not waiving those payments just yet, it's just deferring them for a later time. Those payments are technically still payable. And who's to say that customers who are, it's helping cash flow short term, are they still going to be able to make the payment when the deferred date comes around in 1 or 2 quarters time? So it is in a way making that deferral a condition subsequent, in a bit like the way it's kicking a refinance down the road for 6 months. You've still then got to deal with it in 6 months' time, and who knows what the world will look like then. So I think it's helping in the short term, but we shouldn't forget that it's not, that the pain hasn't been kind of incurred yet. If you see what I mean, it's just been postponed.
Yeah, I know certainly with some of the people I've been speaking to, that wanted to scare everyone. Everyone's talking about this is phase 1, and phase 2 is still to come. Not necessarily of the virus,
absolutely,
of the knock-on effect. We all need to be live to that.
And certainly in the property world, the March quarter date came around, and that was largely okay. The June quarter date still to come, and September as well. So who's to say what will happen in June and September? Things might look a lot worse in terms of businesses have just not received in the whole quarter what they'd expect.
Yeah. Probably something for us to flag is, our advice this week, if we were to run this webinar next week or even the week after, what we say may well change. So as you're all aware, this is fast moving, and as more and more comes out, we'll endeavour to do our best to keep you updated. Perhaps the last question for all of you, if I may, which is, what do you consider the most important thing people should be doing at the moment as regards their liquidity? When you're on the spot. Shall I go to Neil first, perhaps?
Yeah, communicate. Talk to your banks. Don't hide anything from them. Communicate that they want to support you if they can. So keep those regular chains of communication open.
Brilliant. Thanks. How about Nick? Got anything to add?
Yeah, I think I would say, and it's almost to my very opening remark, is that there are different avenues of support. So I think you need to be alive and kind of, I've been living and breathing it a bit for the last 6 weeks, is of all the different avenues of support which are available. So I think if you're dealing with liquidity, it's not just a question of saddling yourself with more debt. There are grants, there are tax reliefs, there are rent reliefs, there's all that stuff. So I think all of those things, when you add them up, will help you with liquidity. So I think it's being mindful of everything that's out there, not just fretting about CBILS loans. So I think there's plenty to go at to help you with liquidity. And I think to Neil's point, in the same way as the banks are supportive, I think the government is actually very supportive as well, and is worried about getting through this phase, whether it's phase 1 or phase 1.5, and see where we get to then.
Tim, for the last word, or have they said it all?
Well, I think I'd probably say two things. The short one is cash in on the bank's agility now, because who knows how long it's going to last for. And I suppose the other bit, and more importantly, I'd say, is that it's not just the banks who lend money. There are a lot of other bridging lenders, alternative financiers, who are open for business. Now, it might be costly, but for a short-term loan that sees you through or gets a new project underway that you can then refinance when the banks come back, it might be worth considering. So I suppose broaden your horizons a little bit. There are a lot of lenders out there.
Brilliant. Thank you. Thanks, guys. I think that's probably about it from us for today. Thank you to everyone who's joined us today and posed some questions to keep the conversation moving. If there was anyone out there who wanted to ask something in a more private forum, at the end of this presentation, a slide will pop up with our contact details. So please do just drop us a line and we will get back to you. I hope you found the session interesting. As I mentioned, we do have our COVID hub on our website, which we are regularly updating. So even if you have checked it out, perhaps give it another look and see if we've added anything else. And that's it from us. So thank you very much, and stay safe, everybody.